Welcome, friends, and a very good morning to everybody. Thanks for logging in and sparing your time for the second day of the summit that Motilal Oswal AMC is hosting. So, the markets are sizzling, going up every day. And, also we are seeing the economy reviving off a very small base. Now, the pertinent question and the topic of discussion today is obviously, the market cap, which is currently at around 100% of GDP of $2.7 trillion. In what form and shape do you see the $5 trillion mark come through for India? And we can pose this question to all of the panelists. Sanjeev, you can go first, and then maybe Venu, Ganesh, and Gautam after that. Over to you, Sanjeev.
Sure, Manish. See, there are 3-4 drivers of ultimately market cap. So I believe the when, to market speculation, it will happen eventually. As the economy keeps on growing, market cap will also grow. I don't think there is any doubt about it. If you look at the history of India's market cap, if I remember the numbers correctly, GDP per capita used to be $500 in, let's say, 20 years back, around 2000, 2001. And at that time, GDP per capita used to be about 40-50% of, or rather, market cap to GDP used to be only 50%. Over the time frame, if I look at 10 years later, in let's say 2011, your GDP per capita moved around 1,500, and your market cap to GDP also moved to somewhere about 90-100%, which is where we are also currently. And currently, we are now roughly $2,000 per capita economy. Hopefully, over time, this will keep on increasing at, let's say, whatever, 5-6% per capita on the real GDP basis. And on a nominal basis, hopefully, somewhere about 10-11%. So I think the math is fairly easy to do. Over time, your GDP will expand, and accordingly, market cap will also expand. So that's not the issue. The issue is, can we grow much faster than that, coupled by some other drivers just beyond the GDP expansion, which will anyway take place in the economy. The second factor I would talk about is formalization of the economy. You have large parts of the economy which are very informal in nature and, very underrepresented as far as the market is concerned. And specifically, I would highlight 3 sectors. One is healthcare, which is globally, if you look at a very large portion of the GDP in India, if you look at healthcare services, it's actually very small. I'm leaving aside the pharmaceutical part, it's actually 1.5 trillion rupees. If you look at the market cap of all the healthcare services in India, it's hardly anything actually. Second is retailing. Again, globally, a very large market cap sector. In India, it's completely informal as of now, and over time, as the sector becomes more formal, the market cap in the sector will zoom like anything in my view. And the third is real estate. That's about 11% of GDP, by the way. But in the market indices, it's very underrepresented as of now. Again, very informal in our economy over there. Hopefully, over time, as some of the benefits of tighter regulation seep in, which is, GST, RERA, etc., sector will become more and more formal. And we're already seeing that in at least Tier 1 and the metro cities. The third big driver I would talk about is, can India have more of manufacturing and, let's say, production of energy within India itself, which are 2 big import areas currently. And here, the economic activity is not captured in India. It is captured somewhere overseas, right? And that is reflecting in the market cap of the overseas companies, not so much in India. For example, India imports 80% of oil and gas. The value of that is actually getting captured somewhere else, not in India. So hopefully, as we move towards renewables, and thankfully, India is blessed with a lot of, solar power, hopefully, we can capture a lot of that value in India itself. Same way, we look at manufacturing, specifically of electronic goods. Again, the market cap of that activity is actually captured in Korea or Taiwan, where chips are manufactured, and we can talk about that in more detail later on. And not in India, hopefully, again, over time, some of these activities start in India and the market cap starts reflecting in India. So 3 big drivers, I would say. One is simply larger size of the economy. Second is formalization economy. Third is, more manufacturing and production within India. And also more services, within India. So, for example, currently a lot of new age value creation in the economy is actually getting captured by overseas companies, whether it be a Google or a Facebook, etc. Can Indian companies, become of a similar scale, if not a similar scale, at least somewhere, comparable? And some of that activity starts getting captured by Indian companies rather than by some of these overseas companies which are not listed in India. So we'll stop here, and we can deep dive into some of these aspects later on.
Sure. Venu?
Yeah, okay. So I think Sanjeev has covered quite a bit of ground. Just to give a very quick perspective around this, ultimately the economy has to grow, which is going to be the key anchor for the market cap as well, unless you believe that the flavor of the entire listed universe is going to change, right? And of course, it would change if the digital revolution picks up in a very different way, where the approach towards market caps and valuations for those companies are very different, and how important that becomes in the overall scheme of things. But purely from an economic growth standpoint of view, I think the $5 trillion number is probably just an anchor than anything else. Even if you're a bear, you would probably, agree that eventually a $5 trillion will be achieved. So the main point of view out here is eventually timing of when you achieve that. And in that context, it's not a debate between 2025 or 2030. If I were to just put a broad top-down perspective, you can achieve that in 5 to 6 years time frame on a 10% plus sort of a growth rate. Now, the more important thing, however, out here is that there is this concept of cyclicality, which is an important variable with which we look at India as well. Now, that's unfortunate though, because in the state of where we are in the economy, we would want to be a secular and a high growth economy for a long period of time, which is what probably China has delivered. But we tend to look at India from an economic lens, which is more cyclical in nature. So if you are lucky enough to get this sort of a relevant and big cycle in the next couple of years, which we can discuss and debate the drivers for that, you could probably accelerate the path towards a larger market cap, even for the old economy enterprises, because sheer depending on how the demand growth shapes up and how capacity creation happens in the economy. So that's one important part of it. But the second part, of course, is that we cannot shy away from the fact that the cyclicality is also a problem for India. The fact that a lot of decision making over the last couple of years were more narratives where execution was actually quite weak, and that's largely because of lack of planning and lack of execution. So most of the things we talk about in infrastructure or manufacturing are largely Excel sheet models. So we have to move away from the Excel sheet models and move towards execution, which is what is going to be the key driver, in my view, over the next couple of years. The other thing I'd want to primarily highlight that the areas which probably we are a bit more excited about from an economic standpoint. One, of course, is something which Sanjeev touched upon was the digital side of sort of things. And we believe it is more of a digital age for India. And it is fortunately so that there have been some decisions which have been taken last year, even if it has been sort of triggered by COVID, which probably is bringing some teeth to the Indian startup ecosystem. And I haven't seen this kind of excitement, back in India for almost a decade now, where the funding access to a lot of these business models is increasing tremendously. Now, it is obvious that quite a few of them may not necessarily scale up, but we don't need everyone to scale up. A bunch of them are the ones who are going to scale up and primarily create a significant amount of job creation in the service economy as well. So this is in some way also formalizing the economy through the digital revolution. It could be centered around fintech. It could be centered around retail digitization, which could be an O2O sort of a model or a B2C model, doesn't matter, or even a food delivery sort of a model, which ultimately is creating jobs at the bottom end of the pyramid as well. So digitization is going to create opportunities across the consumer pyramid, which is an important variable with which I would be looking at the economy. The second part is the manufacturing part. One of the key things I want to highlight that we have all the potential as an economy to move on to that path, but it's a debate that we need to see whether we really want to approach it, the way probably Southeast Asia and China approached it. But the second part to this is that if we were to really get into this path, we need to do two things. One is really accelerate this pace of PLI implementation. You just cannot announce something last year and say that 2 years later, I will tell you what the scheme is. And then it'll take 1 more year to figure out who are the ones who are going to participate by the time it is FY30. Right? So this is completely in the hands of the regulators as to how they accelerate it. The reason I'm saying that is simply because we did this analysis of 75 global companies who took about 90 decisions with respect to where they're going to now shift away from China from a China plus one model perspective. 33% decided to select Vietnam. 10% was Thailand. 6%, 7% decided to move back to US and Japan. And you had, of course, 10% Thailand and 10% India as well. But we could have done and collected a bit more of those easy shifts had been a bit more faster. But I do believe that that's an area where there would be potential opportunity. The third aspect, which is something which Sanjeev covered as well, I believe looking at how China has grown, especially on the manufacturing side and the approach towards the economy, some part of the learnings which should also implement. One being pushing Indian companies in the forefront. Now, you can make it obvious, doesn't need to be less obvious. And to give an example here, while we're pushing Tesla to come to India, we're willing to give them any possible schemes to ensure they set up manufacturing facilities here. But why not give those incentives to local Indian auto manufacturers like a Mahindra, for example, or a Tata, so that they get in a situation where they become relevant in terms of technology and implementation and they become exporters. So that's the second area I would focus on, but I do see opportunities, in parts of the value chain of manufacturing as well, which are going to be the key areas for India over the next couple of years on a path towards this 5 trillion sort of an economy.
Got that. Yes, Ganesh.
Morning all. The way we looked at it is Sanjeev and Venu covered a few points, which is the key point which I had in mind was formalization. And we think formalization will make a big delta in how the earnings growth of companies can get accelerated. We are coming off almost 10 years where earnings growth has been muted. We believe that earnings growth can now accelerate. A combination of multiple reasons. It's demand recovery, it's industry consolidation, we see inflation and on operating leverage. So earnings growth of about 20% compounded over the next 4 years is something which we believe the building blocks for that are now in place. And the formalization will add to the earnings potential. We also need to reckon valuation multiples on a low-balled earnings, and without inflation, they look higher side. When earnings get inflated, we need to expect valuations to get moderated. So it's like earnings boosting valuations and valuation multiples compressing, which means our assessment was it will take roughly, and at the listings which will come, roughly about 5 years is what we think for market capitalization to double from where it stands today. So it reckons earnings growth, it reckons a margin of safety, which we need to build in on valuations being, say, maybe 20% lesser than where we are today, and the new listings adding to this, which will possibly take us to about a doubling in a 5-year horizon. This is our broader assessment. But to specifically look at what can drive these earnings higher, this after about 20 years, we have seen these 4 variables come together. There is the drivers for earnings, demand recovery, industry consolidation, inflation, and operating leverage, and balance sheets of banks and corporates have been largely cleaned up. This last happened in 2003. We have not seen it since 2003. This all things coming during 2011 or 12, we saw inflation, but demand weakened. Last 2-3 years, we saw consolidation without demand. In between, we saw demand recover, but 2015 or 16, but no inflation. So they've come in various parts of the last 10 years, but we have not seen them come together. And we think demand, consolidation, inflation is a potent combination when it comes together for pricing power to be demonstrated. And that means earnings growth eventually, given operating leverage potential. The earnings growth should be the biggest the dominant reason for market capitalization to grow from here on. And that's where our confidence is highest. Possibly in 20 years, we have not seen this construct happen. It's not going to happen in the next 6 months, all of this, but this formula for it to play out over the next 4 to 5 years, that's where our confidence is maximum. I'll stop here. Maybe we'll dive deeper as we discuss further.
Sure. Yeah, sure. Gautam, over to you.
Hi. A lot of points already covered by the previous 3 panelists. I'll just take a step back. If you're looking at 5 trillion, it's going to happen. It's a milestone eventually. Someday 10 trillion may also happen. If you take a step back and see, it took 10 years for us to move from 1 trillion to 2 trillion. From May 7 to, I think, 2017 May. And then from 2 to 3, it took about 4 years, out of which the last $500 billion came in the previous 6 months, from December 20 to now. So the growth rates have not been linear, and it should not be the case either. Arithmetic is quite simple. I mean, if you are looking at the market caps, yesterday we closed at about 3.13 trillion BSE listed companies. You're talking about 5, so that's about a growth of 60%. If you think 10% dollar compounding per annum, because you're talking about $1 trillion, the currency rates will also play a role. So it should take about 5 to 6 years. The important thing, however, is a lot of drivers are changing. And as Ganesh elaborately explained, how earnings is coming together after a long, long time. I mean, the previous decade, you compounded earnings at just about 6%. Way below, I think, India's potential, given all the talk about demographics, infrastructure, and opportunities that we keep on talking every day. But the reality is, last 10 years, you've grown earnings at 6% compounded. Your Nifty has grown at about 8.5% compounded. Last year, you've seen, after many, many years, first year of double-digit earnings growth. And again, as Ganesh explained, you are looking at a good construct going forward for next couple of years at least. So seems that cycle is changing. Your financials, asset quality got cleaned up after many, many years of disappointment. The more important thing, however, is now you're talking about diversification of a lot of sectors. The economy, by and large, has been driven by consumption and financials. And so is the case when you look at even the market constructs. Large part of the index weights are concentrated heavily into these two sectors. And now you're talking about digital revolution, where many sectors are coming up, subsectors are coming up. And then you also are suddenly seeing a lot of discussion about solar and green energy. I'm hopeful that some of the companies belonging to those domains will also come and list. Then you're talking about LIC, Paytm. So, growth in market cap will be a combination of your organic growth from the companies which are already there, a bit of an earnings acceleration which should happen, as we are talking about 10 years of no growth in this economy. Corporate profit to GDP has slipped from 8% at the peak to about 2.5%. Maybe we will reach 3% this year, 3.5% next year. But the room is it can grow further because it has collapsed in the last 8-10 years. And then on top of that, there are new drivers on manufacturing. There are new drivers on formalization post 5 years of GST now, though there are some elements which are still, needs to be smoothened out on GST because states and center keeps on fighting. But by and large, it's been a good reform that we have seen. And suddenly, if you look at the last 5 years of corporate India's financials, GST has helped them really cut costs, expand margins, clean out a lot of inefficiencies. So I think 5 trillion is a milestone in a very long-term journey of India. It should happen. Arithmetic tells you should be about 5 to 6 years, depending on how economy progresses, and we don't encounter any big accident along the way. So that's where I'll stop my opening comments.
Sure. So that was very comprehensive as to when we are likely to see that $5 trillion market cap journey play out as. Now, Sanjeev, coming to you, typically Warren Buffett's indicator that 100% market cap to GDP, beyond that, it looks quite expensive. Now, there are certain sectors, the new age internet companies, etc. They are all a part of the GDP, but they're not reflected in the market cap currently, right? And you'll have many unicorns getting listed, a number of unicorns in the country, more than 100, evolving, will grow over a period of time. They will ultimately come into the market cap. So really that 100% market cap to GDP being an expensive number, is that really going to hold, or are we really going to toe in line with what the global indices seem to indicate, like the US at 200% market cap to GDP and so on and so forth? And the second question is basically, what is the composition of the market cap going to look like? Today, if you look at the Nifty 50, technology and financials make up more than 50% of the total market cap. 38% in financials, 17% in technology, that's 52%. So how is the shape and form of the market cap of the sectors going to look like, given the disruptive forces across all sectors? And particularly, this is relevant for the fintech space as well, which is, there talks that is going to disrupt the banking sector as well. Your thoughts?
Sure. See, on the first point, I don't know whether this 100% is some sort of a limit, because you have several countries which are particularly based on exports. For example, Taiwan is hitting more like 300% now, but it's an exceptional economy. It exports huge amount of its products. Essentially the backbone of entire electronics. As far as the world is concerned, US has now gone to 200%. But that primarily reflects the fact that a lot of US companies are capturing, activity, digital activity that is in other parts of the world. But the market cap of all that is only reflecting in the US markets. I mean, you have giants like your Amazon, Google, Facebook, Netflix, and so on and so forth. Obviously, these are global companies with a massive footprint all over the world. Captures economic activity in just about every country on this planet, but market cap reflects in the US. Now, can India be in a similar situation? Early days, as of now, we have to first, reduce the amount of imports which are a negative drag on India's economy and also on the market cap. So that itself will, provide us some uplift as far as this, market cap to GDP equation is concerned. As Venu also talked about the fact that if we get this manufacturing part right, and I think it's a once in a maybe 20-year opportunity that we are seeing currently. There is a massive shift towards some sort of deglobalization plus diversification that we are seeing currently. And if India plays this strategy well, the China plus one strategy well, you could see a lot of manufacturing being done in India over the next decade or so. I mean, Indian companies are prepared. Also, you could see a lot of global companies setting up shop in India, and all that activity will start reflecting in India. Even if those companies don't list in India, it doesn't really matter because economic activity will be captured in India, which will reflect in consumption, investment, and so on and so forth in other areas, which will get captured in other parts of the listed space. So I don't think this 100% is some sort of a cap as far as India is concerned. Second point is, as some of India's homegrown tech companies scale up over time, they would probably start clawing back some of the economic activity have lost to the, to the global majors. If you look at, I'm just looking at the data for the top 15, 20 unicorns now. Based on last funding round, the valuation already more than $100 billion now. Some of them may not list in India, but even if they pay to list in India, that itself will add significantly to India's market cap. And these companies will grow like crazy, I would think, over the next few years. The market opportunity which these companies have on the digital side is enormous. So they can scale up dramatically over time. And what we're also seeing is a bunch of very interesting smaller companies in the pipeline who will get listed. I mean, I'm not talking about, the unicorns or decacorns. I'm talking about even smaller companies like $500 million, $300 million market cap kind of, or other value kind of companies who are in interesting space like SaaS, etc. And these companies are not restricted to India, by the way. They are global companies now. If you look at the list of clients, they have hardly any business in India. Actually, they are very similar to what the IT companies are actually. Most of their customers or revenue is actually coming from overseas. And you have this interesting companies who are also now scaling up quite nicely with fantastic growth rates. So I see, a lot of clawback taking place of economic activity that India has surrendered to other countries, especially on energy and manufacturing. Both can be done in India. I don't think there is any rocket science behind, at least low-tech manufacturing, assembly operations, labor-intensive manufacturing. What's the big deal? I'm sure we can do it quite easily. And thankfully, over the last 2 years, we have seen a government that is very keen to drive manufacturing in India. Starting with the corporate tax cut in September 2019, all the labor reforms and the PLI schemes. Although the PLI schemes still haven't been optimized to the extent they should have been, unfortunately, because of COVID, I assume. Hopefully, that should also be a big driver going forward. So all said and done, I am actually quite positive that you could be the start of a multi-year investment cycle on the private capex side. And other thing which we didn't talk about that much is, you could actually see a big multi-year household capex on the real estate residential side. All the ingredients are in place over here. And this sector is so underrepresented in the index, it's not even funny. If we look at actually household physical saving as a proportion GDP or household physical investment, whichever you want to look at it, that's about 11% GDP. Look at the market cap of all the real estate companies and the cement companies put together, that's only 5 trillion rupees. That is 1/4 of the GDP activity that takes place in real estate, by the way. And do keep in mind the fact that 40% cement is actually used in infrastructure, not even in housing. So I am very positive on housing, and the reasons are fairly straightforward. Last 10 years, if you see the data for real estate, let's say the 5 major metro markets, the volume numbers are similar actually. what was the peak in 2012-13 we are reaching now after 8-9 years of significant expansion in GDP. Second point is since middle of 2015 prices haven't gone anywhere, which means in real terms prices have gone down or availability has gone up significantly. And the third point is interest rates are also down. If I remember correctly, FY15 used to be 10-odd%, currently below 7%, which itself means somewhere about 17-18% drop in your EMI. So between much higher availability and lower interest rates, I think all the ingredients are in place. And more importantly, there is a deep desire for everybody to upgrade their housing stock. After COVID, people have realized that their houses are not of good enough quality. Everybody wants one more room or two more rooms or whatever it is. So I think this can be the start of a real big multi-year investment cycle as far as household capex is concerned. So all that makes me reasonably positive that one of the drivers of GDP, which is investment, which has been missing essentially for the last decade, that should start coming back in a far bigger way. And effectively, you could have any consumption will do okay in India, I assume, as long as we create jobs on the back of investments. Investment comes back. And I think the drag on the economy, which was always net export, which was negative, even that should start, improving over time. So I think, the factors that you highlighted, 100% market cap to GDP, I don't think is any restriction over there. Would be higher.
It's not a representation of expensiveness or of the Indian markets.
Absolutely.
Yeah. So, Venu, I mean, the same question to you. Would you believe that the weightage of the banking and financial sector at around 37%, investment cycle picking up, real estate, housing, all of that getting represented in the benchmark, yeah, the weightage of the BFSI space as a whole is likely to come down in this journey from 3 trillion to 5 trillion?
Yeah, it's an interesting but a very, very tricky question. And the reason being that, when we talk about economic growth, we're also talking about traditional companies also moving, in a stronger path, even if it is driven by cycles or participating in some way in the opportunity. For example, even things like infrastructure cannot happen without lending. In some way, the traditional financial sector also has to participate in that opportunity. So credit growth also has to in some way expand, which primarily means that the banking and financial sector, along with what Gautam mentioned also about the fact that you have NPA issues being lower and stuff like that. So, but the key thing I would probably say is that the flavor of the sectors within that might change. So, for example, I would give definitely a room for a larger presence for so-called digital as a sector. Now, you can't call digital as just pure IT. And so, it is SaaS as well. It is basically about traditional retail, which is, as I call it, as consumer tech. And of course, it is fintech as well. Now, there are ample opportunities around this, which could probably take a larger part of the overall market pie. I'll give you one sort of a broad top-down understanding of this as to what it actually means. So, based on the sectors which are sort of emerging at this juncture, it could be food delivery, edutech, things like consumer retail, B2C, O2O, all that put together primarily is an opportunity which is going to influence something like $1 trillion of GMV in a decade's time frame. Now, in a very simplistic way, take rates can vary, but you could probably take 10 or 15% take rate depending on what business models, because you would have matured a lot by then. It's basically about $150 billion out of revenue streams just for this part. By the way, I've not captured fintech. Okay, so it's just these sort of areas. Now, looking at how these companies are valued, these days at 10 to 20x, but probably could be lower at that point of time. We're talking about $1 trillion plus of market value just being created by what we see today in terms of these end markets. That's one part I want to highlight why it could be very important, and fintech is another piece. And the important thing of fintech is these things can go really fast. The second thing I want to highlight is that what we see as companies growing today is not just the thing. I've seen things, globally as well. You tend to see a lot of new business models emerge within digital as well. So and those business models, of course, have a pace at which they grow really fast. So you could see a couple of more companies, for example, getting created in the B2C world. For example, the D2C brands, which is another emerging area. The third thing I want to highlight is that this construct as well of certain of these areas which are not limited to India. Now, in a manufacturing sense, it is very difficult to execute that. It's usually difficult to execute because there are still some form of trade barriers. There are specific implications of Europe wanting to give a preferential treatment to, let's say, a Vietnam or Bangladesh on textiles. You can't help it. So you do have to work on those limitations on the manufacturing side, unless you're primarily coming with an approach where you have identified a couple of end markets ahead of others, which is what China does, right? Identify EVs, just focus completely on it. Identify hydrogen, completely focus on it, and have a target setting process around it. Identify telecom as an area, just get into that in a big way, right? So you need to identify new areas in manufacturing so that you become exporters. You cannot build a manufacturing business model by basically exporting traditional old stuff. That's where I think things need to change on that aspect as well. The third thing on this GDP market cap ratios, I fully agree with Sanjeev as well, that there's nothing called limitation. If your economy is doing well, and if you have a lot of large enterprises which are global facing, things would completely change. EduTech, for example, I want to highlight since Sanjeev mentioned more about the SaaS side. EduTech is a very, very clear winner because you have a low cost base in India and you're going to teach the world, right? Various things. So this is going to be a big value creator where you don't see any representation. You just talk about one company, even in the private space, where there's a host of them which will enter. So these are the kind of things which will probably, excite me at some stage in terms of how I would look at, that construct. I don't really see that all of this, of course, translating in a 3-4 year, 5-year time frame. I think the economy also has to mature. These companies have to mature and look outwards. I would give a slightly more longer time frame for, this paradigm of greater than 1x GDP to sort of shape up.
Sure.
Venu, thanks so much. This has been very interesting. You have also written a lot about, some of these digital companies and how this entire move towards intangibles, is one of the biggest, way we are seeing. So one question with regard to this in the context of, the market cap journey as well as the index composition. So if you look at globally, most of the top companies today are, all tech companies. And, when we look at it from an India construct, like if we go back some years, say if we go back around 2009-10, bulk of our index at that time used to be, the way we used to calculate index was on market cap basis. So it was largely oil and gas companies and so on, which were very market cap heavy. And then we moved to, a free float method, and then slowly the banking and the IT, and they became much larger. Not just because of performance, also because of the change of methodology. So when we look ahead, and Sanjeev also mentioned that we are looking at, when we look at some of the unicorns, they already based on the earlier valuations around $100 billion. So when you look at say 4-5 years time frame, do you think the index composition could change significantly? And many of these digital companies, because they have very high free floats, could become a large portion of the index? And would you want to crystal gaze and give us some sense as to what's your thoughts around, what composition the index could look like, say, in 4-5 years' time?
Okay, so rather than putting specific numbers around it, because in the next 3 to 4 year time frame, we're looking at an economic cycle as well, right? So there is a lot which is going to grow in that direction as well. I'll probably agree, in this construct of high free float, especially for a lot of these emerging companies which are going to list, right, which is what a critical sort of a factor. But the other journey, which is very important out here is not a 3-4 year journey, is the fact that they need to encompass a larger part of the old economy ecosystem. Just think about one difference between what was happening earlier in the tech world versus what is happening in the last couple of years, which India is sort of taking over. Earlier tech world was basically tech disrupting tech. Okay, so it was basically disruption on the product side of things. Telecom, for example, you getting into smartphones, and things like the software side of things, where we were sort of enhancing the value of old economy business models by doing that, right? Or even search engines and stuff like that. It's a completely new enterprise business that was getting created. What you are seeing right now in India as a creation is primarily business models which are driving in some way formalization of the economy using digital, and rather than formalizing through being an enabler, they are actually participating in the entire GMV process. Now that takes slightly longer. So even if you take the case of Reliance as well, we are super excited about the O2O opportunity they are in, but are they going to create enough O2O GMV in 3 years? Definitely not. So in a 3 to 4 year time frame, I would probably say you would have a bunch of listed companies which are probably in the 300, 400 aggregate billion market cap range. So you'd have a Flipkart, which is probably going to dominate out there, and some of the fintech companies and edutech companies. So that's a max. 300 to 400 billion is what I'm looking at the next couple of years in terms of their contribution towards the index weightage.
Yeah, so that would be significant. That could be a major shift that we could see.
Yes.
So, thanks, Venu. So,
if I may come in for a minute,
yes,
see, the best way to look at it is, how overrepresented or underrepresented the economy is or parts of the economy are in the index, and then take a view. Because as I was explaining earlier, healthcare, retailing, real estate are very underrepresented in the market. But these are very large parts of the economy, actually. So over time, naturally, that share of these sectors will grow.
Yeah.
Whereas financials, which are probably overrepresented, may go down over time. So I think somewhere the economy and the market cap have to start, following each other in a way, I would say. Obviously, economy comes first, market cap comes next.
Sanjeev, in this context, when we are talking about many of these digital age economies getting represented in the index, how would you look at valuation? Because portion of the index, when these digital age companies come into them in the index, will be valued as a multiple of sales, right? And the typical valuation matrices on EV to EBITDA, prices to earnings wouldn't stand good. So the way we are used to looking at things as being reasonably priced, underpriced, undervalued, reasonably valued, overvalued, how does that paradigm change?
All right, it's a very good question, and it's going to be very interesting for analysts and investors both, to be honest with you. I mean, look at the index itself for the last, just 3 years, actually. Look at how much it has changed. So when we look at historical P versus current P, I tell investors not to, bother basically, because the competitive index itself has changed towards so much of higher quality names now, right? Because 10 years back, the index was dominated by, oil and gas, infrastructure, which are natural, or metal mining, which are naturally low PE companies. Whereas now, if you look at the index, it's dominated more by high quality banks. I mean, PSU banks are largely out of the index, actually, barring SBI. There's nothing in the Nifty also, by the way, now. And if you look at so many of the consumer staple discretionary companies are now coming, which are much, much higher P compared to your traditional, metal mining, oil and gas companies. So now if you're saying index is 22P on a, let's say, March 22 basis versus, 15, which was the average for the last 20 years, I mean, you're comparing apples and oranges, to be honest with you.
True.
But going forward, apples and oranges and pineapples, I don't know what all it will become, to be honest with you. No jokes, but, I think the composition will look very different, by the way, in 5 years' time. And in a lighter way, you will have 4 of Reliance, by the way, in 3 years' time. So that itself will change the composition index quite dramatically. You have Reliance Holding Company and the 3, O2C, Reliance Retail, Reliance Jio, everything will be there. And each of them will be $60 billion. I mean, as of now, probably much bigger, over a period of time. So index will change dramatically. There's no question about it.
Clearly.
Ganesh, over to you. I mean, we understand how FY22 is going to look like, how FY23 is going to look like. Can you give us some peek into how FY24 would look like in terms of earnings at this given point in time?
See, the point which I wanted to highlight on that is, see, when we tend to underestimate the importance of real estate and inflation in many things. For example, the NPA cycle of banks. See, what I've generally noticed is NPAs and commodity inflation and real estate inflation tend to go together in some form. That's why real estate is part of financials. Okay, because for most loans, the underlying security is real estate. And when real estate inflation, which has been absent for almost a decade now, right? When that goes higher, the ability of banks to fund that growth and ability of banks to see lesser NPAs because of that has a profound impact on the return on assets. And we think over the next 3 years, and I saw it in 2004 and 5 when the commodity inflation and when real estate inflation catches up, the impact of that on lesser NPAs for banks actually makes a material impact on banks' profitability and ability to grow also. Okay. Now, what we are seeing in banks now is an exact opposite of what we saw 10 years, opposite of what we saw 10 years back, which is banks are over provisioned and over capitalized. Okay. So you have two variables in the one in the P&L, one in the balance sheet, which is completely skewing the return on equity. And as a result, the valuations of banks. Okay. Now, what we should see going forward is a combination of both getting addressed. It will not happen. It's a 3 to 4 year journey where this plays out. The ROE expansion of banks, of coming off a low base on earnings and or capitalization. This is one of my, if we look into 24, we think this is an important point. The second was when I started talking of consolidation, right? Now, I'll tell you there are about 25 sectors in India where the top few players have disproportionately gained market share in the last few years. Okay. It starts with banks. There are 6 banks who are taking away about 67 to 70% of the incremental growth in the last 3 years. The same story is in housing finance after a few of the other NBFCs folded up or slowed down materially. It's happening in cement, in steel, in telecom, in aviation, actually. It's happening even in passenger cars. Maruti and Hyundai have taken away 75% of the growth. Look at the long list of companies who are just willing to give up growth. It's Ford, it's General Motors, Honda, Toyota, Nissan, Renault, Volkswagen to an extent. So the number of the impact of this consolidation should have profound impact on pricing power. We are yet to see it. I mean, that's what it's always meant to be, right? Consolidation should be great for pricing power. We have not even seen the benefit, and P&Ls have been stretched on costs in the last 10 years. Lack of demand, volume growth, and not much inflation and where operating costs have gone up. When you see the demand recovery come along with inflation and consolidation, the impact of operating leverage is actually very, very high for a simple reason. And I'll give you an example in Maruti's case, right? We assess that for a 4% price hike, their earnings can potentially grow 25%. I'm saying just delta, okay? Because the costs don't grow as much, and this has huge potential impact. Their margins are down from 15% to 7.5%. So how will 24, all this won't happen in 22 for sure, okay? Markets will smell this in 23. The whole impact will play out in 24 only, actually. And then add to the point which Sanjeev started, investment cycle, right? Investment cycle has been absent for 10 years, almost, and all 4 parts of investment cycle, which is corporate capex, household capex, government capex, and global capex, meaning exports. All 4 have been weakened over the last 10 years, and it will not happen overnight. See, if the initial part of capex by corporates will maybe show up in 12 months, and by the time they put up capacities, it's going to be 24. Actually, fiscal 24, not calendar 24. I think that's when. So this whole story that we are talking now of things recovering will actually get visible action on the ground in fiscal 24 only. 23 is when markets should, look at it and start discounting it and start seeing orders flows and financial closures and some of these begin to play out. But it's really a 24 story and possibly, hopefully beyond. Now look at companies like, say, cement or steel, right? Now, just 5 players are today disproportionate market share, and their capacity utilization is heading towards 85+%. Their deleveraging has led to their net debt to EBITDA come down to less than even 1 time. Maybe in another 6 months, it will be less than 1 time. So how will they prepare themselves for the next phase of growth? It's cement and steel. And refineries have been announcing capex, and renewable power is another big opportunity which we see playing out over the next few years. So cement, steel, power, and oil and gas, they are 70% of India's capex. Add the PLI angle, add the household capex angle, add the government infrastructure spend angle, and then you read the global the reflation effect, or you're noticing that China doesn't want to put up steel capacity anymore. Who is going to put up that steel capacities globally? Who is going to benefit out of all of these potential growth drivers in exports. So when you add all of this, it's really 24 when the full benefit will be seen. So the question really is, the risk to this is, over the last 10, maybe since 2009, what we have noticed is the government or the central bank is positively biased towards getting growth back through their monetary and fiscal policies. But once growth is normalizing, they step back. And then we are seeing growth moderate again. So will we see them lighten up their monetary stance? Will central banks globally, or will governments be looking at fiscal pressures coming in 24? Will that impact valuations and eventually earnings? Is actually the risk for fiscal 24. The upside story looks very good. Potentially what can happen for initially valuations and then earnings beyond 24 is a question we really don't know today. Because see, who would have thought 15 months back that India will see a fiscal deficit doubling and bond yields at 6%. Okay. Now, fiscal governments literally or globally have kind of kept bond yields moderated. Now, how will that play out into 24? How will earnings catch up, but valuations compress due to the cost of capital going up? Those are all the question marks which we need to answer as we go into 24.
Sure.
Yeah, Ganesh. So I think one point which you mentioned in your initial remarks also is that the key risk you see is with regard to valuations, where you think valuations could come down 20%. But I'm just trying to so other than the taper tantrum part or the monetary what central banks will do, if you leave that aside as a systematic risk. But then, if I were to kind of summarize it across all, four of you, almost there seems to be a consensus that not only the existing sectors, but, some of the sectors which have been ignored for so long, whether it is real estate, housing related, even on the power side, everyone seems to have a very bullish view across all this. And on top of that, there is a sense that, that all the new digital age companies which will come in, there's a very, very bullish view there. So, almost there's a consensus that, across the market, there are so many things which are looking attractive. So in this respect, like if I were to take what, initially Sanjeev mentioned and even Venu mentioned with regard to valuation, like Sanjeev was like, don't look at the past valuations because, it's not reflective. The entire thing is changing. The growth trajectory is changing. The kind of companies which we are looking at is changing. I think Venu had similar views with regard to market cap to GDP along with you, that, it's not something, which is cast in stone. So in that regard, how would you think about the valuation risk? Because if we are looking at 2-3 years of, growth galloping and, new businesses coming in, existing business, increase their profitability, their ROEs, and overall the new businesses which are coming are extremely asset light. So in that regard, do you think the valuation angle could play a party pooper, or, it's something, which can be ignored and not going to be a major deterrent in the wealth creation journey that we are looking at from here?
I'll take that question. I think markets are not going to think at it sequentially. Initially, the buoyancy in earnings will get markets excited, and valuations will not compress when earnings growth is still healthy. So, but we need to pencil in that risk potentially happening. It will play out after earnings pick up. It's not going to play out before earnings pick up. So first earnings growth, and then there should be a moderation in valuation multiples as inflation also will rise along with earnings. And then the central banks and the government will want to moderate it and take some action, which will bring valuation multiples at risk. But that's still at least 18 to 24 months away before we wake up to that risk. The next 2 years are about recovery, earnings growth, recovery, and listings, which will be more represented in the indices.
I just want to add one thing here is that ultimately top down, what I have always struggled with is index valuations is a very tricky affair, because as you rightly said, the composition keeps changing, nature of companies keep changing. The second thing to also note, remember, is that end of the day, a lot of these sectors trade at lofty multiples, primarily because of lack of opportunities as well for funds, in terms of the flow of money. So as more and more opportunities get created, for example, in the consumer world through technology companies, how does it actually impact the valuations of the traditional sort of consumption names is another thing we need to sort of, put that into picture. So which is by meaning that what I actually intend to say is that, look, one should not assume a significantly large global liquidity environment to last forever, right? So in that world, how does one look at valuations is purely a test of how companies are essentially doing. So on the earnings front or in terms of own business models and how they sustain that.
So in the interest of time, we'll have one question for Gautam. Gautam, how do you see flows? And look at capital market intermediaries, record flows coming in through retail participation. Going forward in this journey from 3 trillion to 5 trillion market cap, inflation being put in an angle, and negative interest real rates. Do you see this sort of a retail participation happening along with foreign institutional and domestic institution participation, or you see a large part of savings moving to the physical asset market and financialization of savings in a real interest rate negative scenario is likely to create a hiccup? Gautam, over to you.
Manish, you've just seen the beginning of financialization of savings journey. All of us are excited that last 12 months have seen record opening of demat accounts. But one statistic that we have to also see is how many are yet to be opened, right? We are saying 1.5, 2 million, 3 million, 4 million. I don't know what is the number on a run rate basis now. But there is a whole lot of population which is yet to test the equity culture in India yet. And given the way rates are today, you mentioned about negative real rates. Property prices have been stagnant for almost a decade, which Ganesh explained beautifully. So the room for a retail investor, so to say, when it comes to financial savings, it's quite obvious. You have to go to the equities given the long-term return trajectory. And this time around, if you see the granularity of the retail investments over the last 15, 16 months, this is not a typical retail euphoria where only the subpar stocks have done well. Retail has done really well. They've invested in good quality stocks. If you look at the data around the holding patterns of about NSE 500 companies. And I actually believe that this is just bigger. We have a long way to go. This is not going to end with 4 or 5 crore of demat accounts in India. The important thing, however, to note is in the historical data points. I mean, if you look at the past cycles in equities from 1990 till about 2017, 18, typically retail participation has taken a backseat whenever you're in a bigger drawdown. So that still remains to be tested, because what has happened is people who have come in from March 20, they've not yet tested a drawdown, or even if I were to say we have seen correction, but very, very limited days of correction. So how do they behave when they encounter a 12-month, 24-month kind of a correction? Time correction is something which is yet to be tested. But the fact of the matter is, if the earning cycle is changing, the economic drivers are changing for the better, which Sanjeev mentioned and discussed about manufacturing, real estate, housing cycle, then I think the India's corporate earnings story would have begun, after going nowhere for almost a decade. I don't think the corporate earnings will peak out with just 1 or 2 years of growth. If historical evidence is anything to go by, typically when the upcycle begins in corporate earnings and when more sectors come and participate, then the story can elongate a lot. And that is where I think there is a lot of room for retail participation in Indian equity markets to go higher from here.
And would you really say that, capital market intermediaries is also going through a disruption? In the age of internet, it's a non-linear model, could lead to some significant re-rating. What's your sense out there?
I think we are already seeing the evidence of that through multiple entities. The entities which are still to be listed, they're making profits which are much higher than the entities which have been in existence for 2 decades, 3 decades. Look at the profitability of Zerodha, right? That tells you a lot, because this game is now changing and it's being played very differently by different players. And arrival of new set of players always shakes the industry, especially the incumbents. And that is where the value migration happens. We've seen the evidence in 20 sectors in the last 5 years. And we are in the midst of value migration in virtually every sector, thanks to GST and so many regulatory landscapes changing in the last 4 or 5 years. Virtually every segment of the economy has seen a disruption. Post GST, Demon, RERA, I mean, you can keep on counting. And the financial intermediaries are, no exception out there. So I think this will evolve. And even the incumbents will fight back. It's not going to be an easy win for the new disruptors either. So you're going to see a lot of competition, and ultimately anything that benefits the consumer, the end consumer, is more than welcome.
On that optimistic note, thank you, gentlemen. It was quite an insightful session, and we'll call it in the interest of time. Thanks a lot.
Thanks so much for your time.
Pleasure.
Thank you.
Thank you.
Bye.